You're listening to the Homeownership podcast by Momentum Realty, real estate talk for buying, selling, and owning property.
Hey guys, Sean Patrick Maloney here, broker owner of Momentum Realty, located in Hanover, Massachusetts. Welcome to episode 22, Tapping into Equity. I'm your host, Sean Patrick Maloney. I'm here today with Chris Devin of Cross Country Mortgages out of Norwell, Massachusetts. Thanks for joining me today, Chris.
Thanks for having me, Sean, as always.
Look forward to talking to you a little bit more about refinance and equity and how it all works. I know we're at a historic level for low interest rates, and right now is a time where prices are high, interest rates are low, so I think from what I know, that's a great time to refi.
Absolutely. Hot topic right now. Rates are definitely dipping. We are getting close to all-time lows. My gut says by the end of 2019, I think we are going to hit all-time lows. They're talking about the 10-year potentially hitting zero. Rates, the 30-year fixed is in the high threes, heading towards the mid threes in a lot of situations, and 100% a great time to tap into equity, refinance your home while rates are low.
What I want to start off talking to you about, Chris, is the different types of lenders and mortgage professionals that are out there and the benefits to working with a local group that does everything with in-house. Can you tell me a little bit about that?
Absolutely. So what's interesting in today's world, especially with technology, is that there are a lot of different players in the game. And I find that a lot of people just don't know where to go, what the best options are. When you're watching games on Sunday, Stanley Cup, let's say, you see Quicken Loans jumps in. There, I said it. Okay. I'm going to use that name. And they have the Rocket Mortgage, right? Reality of it is that technology that they're talking about, most lenders have that today. When you go with those big lending institutions that are nationwide, a lot of times you're working with service centers. Okay. So you're calling into somebody in the middle of the country who's going to help you out, but they're more robotic. They're not invested in the local neighborhoods. They're not invested in the local market. And at the end of the day, if your deal goes sideways, guess what? I don't really care because they're just going on to the next guy, right? So I highly recommend tapping into a local lender, somebody that you can walk into their office, somebody that has everything in-house. What I mean by that is when it comes to getting your loan done, you have to deal with the loan officer, you have to deal with processing, underwriting, and closing your loan. And when you're working with a team that all works under one roof or, is literally a team and local, it's going to make your loan move that much smoother versus, let's say, going with a big bank like a Chase or Wells. Okay. Those guys, and for the most part, operate out of service centers. When you're looking for status, you're calling in with a loan number and talking to a different person every single time. It's almost like being at the registry of motor vehicles. Like, take your ticket, next number, please. What can I help you with? Completely different format.
Sure. And, one of the things that I think always comes under scrutiny that people attack people for is commission-based salaries. And I don't think they understand the importance of incentivized earning when it comes to working a home loan, and the fact that a lot of these larger banks actually payroll their people. So when it comes time for 5 o'clock on Friday night, they get out for the day. And obviously a lot of the local firms are incentivizing through commissions, which, talk a little bit more about that for us.
Sure. What I find interesting is that the large banks that are federally chartered don't need to be licensed. Okay. So when you walk into a lot of these places, the gentleman or woman who is helping you with your loan probably opens up checking accounts. They can do CDs, investments. They're wearing a lot of different hats, right? What's amazing to me is that myself, like a lot of local lenders who work for independent mortgage companies, we actually have to be licensed. Okay. We have to go through testing and continuing education. And that's all that we do. So, it's beneficial to work with somebody like that because that's all that they do. When we're not doing checking, savings, and all the different products, and we're incentivized to make it work. Most of us work 100% off of referral and commission, like you said. So we're going to be more apt to answer the phone at night, respond on the weekend, get you what you need, because our livelihood based is based off of making the clients happy and having them refer us in the future. Completely different platform than just walking into a bank.
That makes sense. So obviously, I always like to point it out to my clients that it makes sense, because it also in turn makes my job easier. Not that it makes it easier, but it makes it more easy to find success in closing on the house that we're looking to, because a lot of times last minute things and just the way that operations work kind of just messes with the deal. But one of the things I want to talk about next is let's start to jump into the refi topic. When a person owns a home, how often should they be checking in with their lender? Is there like a certain rate percentage change versus what they have, or a timeline, or what's best for them to really reach out?
Another benefit to working with a local lender. Most of the time, if you're working with a loan officer that knows what they're doing, they're going to be monitoring your mortgage for you. Okay. So every scenario is different. What I find interesting, Sean, is that after somebody closes on a home, a lot of times they forget about their loan outside of making the payment, hopefully, right? But there are rate movements and there's different reasons to tap into equity. And a lot of times there are financial solutions that are tied to the equity of a property. People don't even realize that they exist, taking cash out, consolidating debt, home improvement, etc. So, like I said, if you're working with a top local lender, they're going to stay on top of that for you versus the bank that just writes the loan and kind of moves on. But if you are in that situation, it makes sense. I'd say at least once a year, maybe twice, depending on the year. This year's a perfect example, is that the forecasted rates are going to continue to fall here. So we've been talking to our clients since January 1, and making them aware of where the market's going, if the opportunity is there or not. A lot of times we're working with people where, let's say, they purchased the end of last year, and we're just not at the point yet where it makes sense, but it's probably going to be worth it in the next 30 to 60 days. So we're monitoring that for them to make sure that they're in the best loan for their situation. Refinance for a lot of people can be a no-brainer, especially if there's no costs involved, where they can pay off their current loan, create a new loan, and save on a monthly basis. It's a no-brainer.
All right. So can you tell me a little bit more for the people who don't know what a refi or a refinance is? And then the other one that I was wondering on is, with a refi, is it possible to roll in closing costs on something like that? And that way the person can do a no money refi, or does it cost money to refi?
Right. So a refinance is paying off your current loan, and can be for multiple reasons. Okay. In the market that we're in right now, a lot of people are refinancing to lower their payment, to drop their rate. Sometimes even people are shortening their term because of the difference in rate. People say, you know what? I was at a 30-year fixed at 4.75. I'm going to go to a 15-year fixed at 3.25. My payment's not going to be that much higher, but I'm going to save a lot of money over the time of the loan. Others are just saying, you know what? I closed last year. I'm at 4.25. I can save, I'm making up a number, but let's say $150 on a refinance, dropping to 3.75. And that makes sense for them because they're saving money on a monthly basis and creating more cash flow for themselves. When it comes to cost on a refinance, you hear a lot of no cost loans out there. Okay. At the end of the day, there's no such thing as a free lunch, right? So what happens is with those no cost loans, which we do a lot of them, it's basically built into the interest rate. The costs are built into the interest rate. For example, let's say we're doing a $350,000 loan and the closing costs are typically 1%. So call them around $2,800 to $3,000 on a loan that size, maybe a little bit less than 1%. You probably have two options. For example, you might be 375 paying closing costs. And with those closing costs, to your question, you can either roll them into loan amount. Very rarely do I see people pay them out of pocket. Okay. Or you can opt for option number 2, which is to do a no cost refinance. And typically, depending on the day, is usually around 0.25% higher. On a larger loan size, it might only be 1/8 of a difference. And it's as simple as just running the numbers for a client. And that's what we really take pride in is showing people what their options are, asking the right questions. How long do you plan on being in this property? what are your goals for the property? Because if they're break even on a refinance and paying costs is, let's say, 5.5 years, but they might move in 3 years, well, it probably doesn't make sense to pay costs or roll them in. Well, everybody thinks it's always about the lowest rate. That's not the case. I can show you examples almost on a daily basis where a higher rate makes more sense. And this is a perfect example where a no-cost refinance might be a slightly higher interest rate, but you're still taking what I call your free savings off the table, and you're not investing in the refinance, which can benefit you down the road, especially, Sean, in a market like this. Because what if you paid, let's say, $3,000 in closing costs and rates continue to go down? Now, let's say you refinance from 4 to 3.5, and what if they go to 3? Now you're putting more money into the deal. Does it really make sense? Well, what if you, rather than refinance at 3.5 paying costs, what if you did it at 3 5/8, took the quote unquote free money off the table, and then the market continues to go down 6 months, a year down the road? We do it again. No cost to you, free savings in your pocket.
That makes sense. And I think all this kind of alludes to the value in kind of creating a lifelong partnership with a mortgage professional that you can trust and that is looking out for your best interests.
100%. And there's plenty of local professionals out there that do a fantastic job. Obviously, I love what I do, and I've been doing it for a long time and more than happy to help in any way. But there are definitely professionals that can help you and monitor your loan for you. It makes a huge difference versus, perfect example is just, people just think that the lowest rate is the best rate for them. And that's not the case.
Excellent. So let's jump into the next subject, which is a type of refinance called a home equity line of credit, or sometimes called a HELOC. What is a HELOC?
Home equity line of credit is a great tool for a lot of people. Okay. Typically, you're going to find like local credit unions and some of the banks. This is a niche product for them. It is a separate loan. Okay. So a lot of times somebody might have a first mortgage at a great rate. They don't want to touch it, and they're looking to tap into their equity for home improvement, for debt consolidation, for cash emergency. A lot of times, Sean, people will put home equity lines of credit on their property just as a safety net. It's great to have as a rainy day fund. So the key to a home equity line of credit is that you actually have equity in your property. A lot of banks will go to 80% combined loan to value, meaning what you owe on your first versus what your line of credit is on the second versus the value of your property. There are a decent amount of banks that will go to 85, and there are a few that will go to 90% combined loan to value. If you're looking for a home equity, I'm more than happy to help. You can reach out, and I can point you in the right direction of different institutions that go to the different combined loan to values. There's benefits and cons to all the different options. But a home equity line of credit is a great tool, especially in a market like this where they're talking about the Fed funds rate being cut. That has a direct impact on home equity lines of credit. It also impacts credit cards and student loans and car loans and stuff like that. So we're in a great environment where rates are going down on this product. I will tell you that in years past, even like last year, where prime was going up, a lot of people that had home equity lines of credit were looking to consolidate them into their first loan, because if you have high balances, and I use 75,000 or 100,000 in a lot of cases as an example, when you see your payment going up, that can be intimidating for a lot of people, especially if you have fixed income. Okay. So I love the home equity line of credit if it's a rainy day fund, if you need money for a short-term need that you can pay off if needed. If rates go up, it's a great option. I will tell you that if you're just looking to tap into your equity to take like a long-term loan, now is a great time to do a cash out refinance, which is redoing your first loan like we were just talking about and just taking cash out at a fixed rate. So a lot of different options. I know it can be complicated. I hope I'm not babbling here, but the home equity line of credit can definitely be used effectively in this market for many different reasons.
Excellent. So I know a lot of people throw out the term bridge loan and they talk about all these different things, but in reality right now, is a home equity line of credit what people are mostly referring to when they are doing a cash out, buy another property type scenario?
Right. A great question. So a bridge loan, original bridge loan is almost extinct at this point. There's not a lot of people doing them. It's a short-term loan. It was an expensive loan. And now you're seeing a lot of people use home equity lines as a bridge, and it's a lot cheaper. Case in point, I just worked with a client that was a move-up buyer. Okay. They lived in Foxborough. They owned a home that was worth $600,000 and they owed $300,000 on it. Okay. All of their assets are pretty much tied up in the equity in their home, but they're looking to purchase another property. They were moving to Westwood and buying for $850. Okay. They didn't have the 5% fully. It was close, but it was going to literally, drain their bank account to put down that deposit on the new property. So what they did is we did a short-term fix. We tapped into their equity. We put on a home equity line of credit. It took about 2 weeks from start to finish, and they were able to write a check and tap into the equity of their property for that 5% down. They also used it for a little bit of home improvement. They wanted to paint the house and do a few other things. So they were able to use the money in the property to act as a bridge to their new purchase and do some fixer-upper stuff for their new buyer. So can definitely work in a scenario like that.
So in that scenario, when they sell the original home, they then pay off the home equity line of credit on it on the way out the door?
Correct.
Excellent. So that seems like a great way to leverage off of your own money, because I know all of us here in America, we're usually pretty cash broke, but most of us, our biggest holdings are in the equity in our properties. So it's great to know that there's different ways to use those and for cheap overall percentages.
Right. And it used to be a tax, right? The interest on the home equity line of credit used to be a tax write-off, like the interest on the first mortgage up to $100,000. That has gone away in recent years. Who knows if it comes back? But no matter what, with interest rates being so low right now, the home equity line of credit is definitely a great option for a lot of people.
So I know we've talked about a couple different rates and everything, but what is the current 30-year rate at, and how does it compare to the past?
This is a really tough question, and probably the most common question that I get. People don't realize is that there's over 10 different factors that go into an accurate interest rate quote. People don't want to know that, though. They just want a quick answer, right? They drive by a billboard and see a low interest rate. They don't read the fine print. So I kind of play the middle. I mean, to answer your question, interest rates, 30-year fixed, 15-year fixed are in the threes. And if you look at the last 50 years, we are pretty damn close to absolute lows, right? In 19 years of doing this, I have locked 30-year fixed at 3.25 for a short period of time, and I believe 2013. Okay. So we're locking people today in the high threes, but they're trending downward. So big picture, guys. I mean, there really hasn't been a better time to capitalize on interest rates outside of 2013. And I think we're going to be there sooner than later. At the end of the day, like I said to you before, dive into it with the lender. Realize that in most cases, rates are rates. You want to be working with a local lender that's going to get you to the closing table on time, protect your investment, protect your down payment, and make the process as smooth as possible. Sean, I know that we've talked about this. We've had some tough transactions with some of the big lenders out there that you can't track down loan officers and you can't get what you need in a timely manner, and closings have been delayed. People don't realize that it's not just interest rate and closing costs. It's getting to the closing table on time, because if you don't and the seller doesn't agree to extend, it could cost you a lot of money.
Yeah, I've gone through that several times actually, and currently actually dealing with one with Quicken Loans themselves, and it's always a battle. It's always figuring out how we run with it. And when you're talking about people's housing, I guess the biggest challenge, it's not the money, it's where do you live during the time that you've now committed to your landlord that you're out and you're heading to this purchase, and the purchase isn't ready to be purchased and the landlord's ready to have you out of the building, and basically you kind of almost become a squatter where you're not willing to leave, but you were willing to leave, but what do? And you go back to mom and dad's house or temporary storage or all the different things that come into play, which I think a lot of people worry about the money side of it and everything, but the logistical battle of having children and school systems and things like that can be really challenging.
What if you have pets? What if you have a lot of stuff that you needed to move? What if you have kids, like you said, and you are not closing on time? And it's mind-blowing to me how this happens. In a weird way, I'm kind of grateful for it when I hear these nightmare stories, because we're lucky we have a local team and that doesn't happen with us, knock on wood. But, in some of these cases, I've picked up messages where banks turn around to somebody and say, you know what, we're not going to be able to close for another 2 weeks. And that's not okay. So, interest rate questions are a great question, but don't just hang your hat on the rate.
Thanks for joining me today, Chris. Why don't you tell people how they can reach out to you and get a hold of you?
Sure, guys. More than happy to help in any way that we can. You can check us out at chrisdevin.com, CHRISDEVIN.com. Follow us on Instagram, Facebook, and look forward to hopefully hearing from you.
Thank you so much for coming in today, Chris. I really appreciate it, as always. If anybody has any questions out there, feel free to reach out to me directly through direct message, text message, give me a phone call, whatever works out best. Remember to follow the podcast, and we really value the fact that you continue to listen to the episodes. We look forward to talking to you next week. Thank you.